And welcome back from that break. Glad you're still watching Science Breakfast with me, Alan Hubbard, and the sign language interpreter is Esther Kendi. In studio, we are with Mr. David Gitau. He is the CCO of Lofty Coban Investments Limited, and we are discussing matters investing your money and making sure that it grows. Mr. David, before, as we're going for the break, you brought my attention to a very important question that probably even our viewers have. In regarding property income, the question is, do we build or do we buy? Because there are also so many uprise buildings, and we see them in the Kilimanis of this country, Kileleshwas and the likes, where you are buying a section of an uprise building. Which is the best way to go in terms of investment?
Both are different, decent ways. But let's go back to basics.
Yeah.
And let me take you back to the discussion we had earlier when we were dealing with growth. Remember we said money is made at the beginning and not at the end. So one of the things is, if you're building to construct, make sure you're not buying the land at market value. You're looking for a distressed property or a distressed seller so that you get the land at a cheaper price so that your rental returns go up.
Yeah.
Same thing with buying ready-made buildings or whatever property which already has tenants in it. Again, here you're also looking for a distressed seller so that your returns can go up. But either way, whatever route you take, if you decide to go the construction route, you're taking on, again, extra risk. One of the risks is, of course, construction risk. Issues of price escalations on materials and that kind of thing. But remember, you're starting from scratch. You have no tenants. You have no tenants, so you have to do your own level of advertising and that kind of thing. So essentially, your returns should be higher from going in the construction route. When you buy something that is ready-made or that is already working, then you already have tenants. There's already income flowing from the word go, and generally the returns tend to be low. One piece of advice, especially if you're going the construction route, is always involve professionals from the word go. And in this case, I mean people who understand real estate and are able to do what we call like feasibility studies and tell you this is the best use of this land. Whether it is one bedroom, bed sitters, 2 bedrooms, depending on how they view the area, they're able to advise you which is the best route. Of course, the smaller the unit, the higher the return. So typically 1 bedroom, or let's say bed sitters would typically have higher returns than, let's say, bigger 2-bedroom units, because of course when you're renting more, you expect on relative terms to pay less. And of course, depending on the area, you know, even bed sitters, bana unajanga bed sitter mingi sana, but the first guy, the first tenant, or rather the first occupant of the first house down there is usually the caretaker, because mtu anaweza toroka usiku. He can leave his mattress and just take off. So you need that kind of thing. But paying. When you're looking at 1 bedroom, 2 bedroom, and you're looking at the family setup, it is highly unlikely that a family will take off in the middle of the night.
Interesting. Now, as you were responding, a light bulb moment went off in my mind. Not necessarily a light bulb moment, but then there are those people who take these units and flip them and furnish them and put them on renting applications without mentioning any. Would you say that that is also an investment route that somebody can use to grow their income? Probably it's not long term, but for the short term.
Even as a long term strategy, that makes a lot of sense, because I'm assuming you're talking about issues like Airbnb. Yes, that is the same. It's the same concept. You, of course, again do your calculations and know, okay, how often in a month will I expect this thing to be occupied? What are my rates? How do I ensure full occupancy? And once you have done the mathematics with the financial analyst, they'll tell you, I think it's best you charge this amount. This is going to be your return, which is decent. With this amount, you are almost guaranteed of regular visitors. But the concept is the same. It is all rental. It's all just leasing space. It doesn't matter.
All right. And now to our conversation on bonds as a source of income. For someone who's never invested in bonds, what exactly are they?
Essentially, bonds are just lending to some entity, whereby you know exactly how much you're lending at the beginning, so it's a specified amount.
Yeah.
You know the period that you're going to lend that entity for, so, and typically this is more than 1 year. So with capital preservation, you're looking at investments that are below 1 year, but here you're looking longer term, anything below 1 year all the way to 30.
Yeah.
And of course, the rate at which they're going to pay you that interest is known from the beginning. So here we're not predicting. Here we know exactly how much we are going to get.
Yeah.
And so who are you lending to? You're either lending to a corporate and or the government.
Yeah.
So if you're lending to government, now government will borrow through treasury bonds, which are now longer term.
Yeah.
And generally, when the government issues bonds, they're looking at financing longer term projects. If you're lending to a corporate, we call that a corporate bond.
Yeah.
Unfortunately, over the last maybe 10 or so years, we've not had any companies really coming out to borrow in the bond market.
Yeah.
But again, when companies do so, they're also looking at long-term projects. And here, we're not saying very long-term, but they're looking to typically for 5 years. But they want to finance projects that are basically, again, long-term.
Yeah.
Yeah.
And then how is that income predictable? The longevity, is it what makes the income predictable?
Yes. So let's put it into perspective. So let's assume you want to buy a treasury bond, and essentially here you're saying, let me use 100,000 as a starting point. You're saying, I'm going to give government 100,000,
Yeah.
and for a period of, let's say, 2 years,
Yeah.
whatever period, at a rate of 10%. Let me use 10% because it's easy to work with. So what you're agreeing with the government is that they are going to pay you 10% as interest for the 100,000 that you have lent them.
Yeah.
So what are you expecting? Every year, they're going to pay you 10,000 Kenya shillings.
Yeah.
And at the end of the period, they're going to return back your original 100,000.
100,000.
Now, typically, most bonds will pay you twice a year. So
Yeah.
that 10,000,
You
they'll
get
pay you after 6
5,000,
months.
5,000.
Exactly.
Yeah.
And you see now that amount is known from the beginning, that on this particular day,
This one is going to hit my
this
account.
one is going to hit my account without fail. 6 months, and at the end, so that's where the predictability comes in. As opposed to rental, where you're assuming and making calculations of vacancy. Here you know for a fact that A, B, C, D is going to happen on this day, this amount. And even when you look at the schedule of payments that government will give you, it is specified. This is the date of payment. This is the date of payment. This is the date of payment.
Do they ever default?
No, like we said, even when we're talking about capital preservation, we talked about treasury bills. They will borrow and pay you. Kikumana kabisa, they will print money and pay you. Default comes in when you borrow in a different currency. Like if, in the case of now, where we would be borrowing in US dollars, what we call the Euro bonds, because you can't print dollars.
Yeah.
So there is added risk for the government. But even then, they will always figure out a way
to go about it.
go about it.
And then are government bonds safer than corporate bonds, and what's the trade-off?
Government bonds are safer because of that element of guarantee. Remember, corporates, anything can happen to a corporate. You start off, a corporate is looking bright, they borrow money, but something could happen in the future that basically diminishes the corporate's capability to pay you.
Yeah.
So treasury bonds are way safer, and then because corporate bonds have that element of extra risk, so the return on a corporate bond
Is way higher.
should be higher. Yeah.
So the moment I'm being given a deal that is lower than the treasury bill and it's a corporate bill, I shouldn't take it.
No. First is, remember, everything is pegged on, let's even start with the treasury bill. Treasury bill, then you go to bank deposits, slightly higher, then you go to commercial paper. That's one category. On the category of treasury bonds, you have treasury bonds by themselves. So whenever you're comparing, if it's a 5-year corporate bond a company is issuing, compare it with a similar 5-year treasury bond that the government is issuing,
Is giving.
and then apply a premium on the government bond that is being issued.
Yeah.
But because there is a higher risk in the corporate, then the expected return should also be higher. Yes. But of course, there's not added risk that that corporate can go into serious economic headwinds and actually default.
Yeah.
And we have had defaults in the past, but that is the nature of investing.
Absolutely, because corporate naweza kuwa sahii inatengeneza hii koti and it's in demand, and 5 years later it's no longer in demand.
And ulikuwa umekopa pesa from the public or even from the bank.
Yeah.
Yeah.
The question that you brought in the time scaling, and that was my next question. What kind of time frame should one expect before seeing steady returns from bonds? Is it really supposed to be 5-10 years?
The steady returns actually come, I would say, immediately, because remember you're going to receive some interest every
single 6 months.
Yeah.
Yeah.
So there's no difference between even a property and a treasury bond, because there's that initial investment, and then based on that initial investment, you expect a steady flow of income.
Yeah.
So with property it's monthly, but with treasury bonds it is yearly. What we do with most of our with some of our, particularly with the high net worth clients, when we're advising them, you can actually structure your bonds or your investment in bonds in such a way that you actually get a monthly income. So you know this bond itanilipa January and then
Ingine nilipe
June.
February.
This one will pay me February end. So you have a laddered approach so that you make sure that out of all this money that I've put in, napata kitu every month.
So let's do this practically. Or I hope this would be a practical way. I came to Lofty Coben and I have 10 million Kenyan shillings, and they say I'm going to invest $1 million, and I say 10 million because the return would be reasonable, and say I'm going to invest 1 million in January. So then that would mean by June, July, I should be getting around 50,000, because $1 million, 10%, that is 100,000, right? Then by next year, January, I'll be getting another 50,000. Then I say, let's buy another bond in February. Is that
it's something similar.
Yes.
Though of course we can always work around the numbers. With bonds, again, there is the issue of you going direct to the market. So what we were discussing is we going direct to the market, and then making sure that whatever bonds we are buying, we are staggering them in such a way that we have different bonds paying us interest at different times. However, but that happens when we're doing private wealth management for our clients. For the regular mwananchi, not too much choice. How much is the minimum for treasury bonds? About 50,000. But if you don't have that 50,000, what next? You can go into what we call a bond fund, or what they call a fixed income fund. But now, typically, fixed income funds will pay you in June, end of June, and end of December. All of them generally. That's how they are structured. So when you go direct, you have leeway, and you have leeway to structure your investments. But if you have less money, go into a bond fund. However, there you are stuck in terms of what do you call it?
The returns at the time they are coming.
Now, one thing that needs, I think, recognition here is that when you go direct into a treasury bond, you know exactly how much you're going to be paid when. However, in a bond fund, you are not too sure how much you're going to get. You just have a rough estimate. It depends on how well that bond fund is doing. Okay. The other, so you might get after 5 months or 6 months, 5,000 bob, then after another 5,200, that kind of thing. The other difference between the two of them, going direct and going through a collective investment scheme, is that when you go direct, that bond has a set maturity date. It could be 5 years, it could be 4 years, it could be 30 years. However, in a bond fund, it operates like a perpetual bond. Okay, it's like a bond forever. So if you put in 1,000 and never do anything else,
the 1,000 will be there.
You will the 1,000 shillings will still remain intact, but you will always receive something every 6 months in perpetuity.
Yeah.
Yeah, so that is a two big things. I think in terms of risk, and I think this is where, I think I need to mention this because this is where there's a very big misconception.
Yeah.
Because people will come and tell you, oh, treasury bills or treasury bonds are risk-free. But that is not the case. And remember, when we talked about capital preservation, we said you don't want your money to fluctuate downwards. It should always go up.
Upwards.
When we talk of growth, it could either fluctuate up or down or just remain constant, but you want the fluctuations overall to go up. One of the misconceptions with income objective is that your initial principal can actually go down, both for treasury bonds as well as property. And this is why. Let's make it a bit practical again. Let's assume you are lending to the government 100,000, 10% interest for 2 years. Let's look at the first scenario. Every 6 months, you expect something.
Yeah.
So scenario one, if you want to sell, what should you expect? You expect the buyer to pay you that 100,000. Plus all the interest that you have made as the owner of that bond. Whether it is interest, if you want to sell for 3 months, you should be paid for being the owner of the bond for 3 months.
Yeah.
Because once it changes hands, that guy will be paid the full interest by the government. But you are the owner at some point. Now, he's paid you 100,000. Sawa. Let's look at another scenario. Same facts as the first scenario, 100,000, 10%, 2 years. But now, you want to sell. But when you're going to sell, interest rates in the economy have gone up to 12%. And you need to sell your bond, which is offering 10. Who would want to buy your bond
At 12%.
at 10% when they can go direct and get at 12%? This is where now the kizungumkuti begins. Okay. For anyone to buy your bond, you must make that person indifferent from buying yours or going direct to government
market, yeah.
or to the market. And how do you make him indifferent? By ensuring that he gets 12%. And how do you ensure that he gets a return of 12%? You will tell the guy, instead of 100,000, when he pay 98K.
So that now he makes that difference of 2,000.
Exactly. So because at the end of the day, government will return the 100,000 to him. But remember, he paid 98K.
So
he continues getting 10%, but that 2,000 difference makes up for the 2%.
Yeah.
So he gets a total return of 12%. So he's fine, whether he went to the market or he, We call that risk, the risk that interest rates will go up and your bond value will go down. What you put in your bond will actually go down. We call that interest rate risk. And that is a risk that investors in bonds should be aware of.
Yeah.
Most of the people are not aware of that risk. When they go to sell their bond because they have some problem, they think the stockbroker is conning them. But interest rates have simply moved up.
Yeah.
So one of the pieces of advice, especially as a retail investor, if you're going to buy a bond, make sure, because you're not an expert in looking at where interest rates are all the time. If it's a 10-year bond, just make sure for you, the objective is to get that income for the next 10 years. Whether the bond fluctuates up or down, no problem. So that is now the major risk that people don't understand.
Yeah.
But let's flip the coin, kidogo. You've invested in the bond, and then you want to sell, but interest rates have gone down to 8%. Okay? And you want to sell. People in the market are only entitled to 8% return, but yours is returning 10%. So what happens in such a case? You must make sure that when you're selling, the guy gets only 8% as return. So you tell the guy, fanya hivi, give me 102,000. He'll receive the 10% return. However, see, he paid you 102, but gets at the end 100,000 from the government.
Yeah.
So that is 10% minus that 2%, then he ultimately gets 8%.
8%.
So you as a holder of the bond, in such a situation where interest rates have gone down, your value has actually gone up. And that's why we said, when we are talking about income, the value of your investment can go up it can go down, and it can remain constant.
Yeah.
However, the good thing is that as the bond approaches maturity, it goes back to that
Initial
principal amount.
Yeah.
But remember, it's just like property. You are not interested in the ups and downs. You are interested in that regular income.
As we're winding up the conversation today, if you had to advise a beginner, which would you recommend they start with? Property or bonds, and why? But also, I am fully aware of the journey that we've been walking, because we started with capital preservation. After capital preservation, now we talked about growing that income, taking a little bit of risk. But right now, we are sort of talking about less risk and making sure that our money continues to grow, but with minimal risks. When we are at this stage, then where would you advise us to invest our money? Property or bond?
I would advise both, but it's not possible to start with both because of the amounts of money required. So typically, you would first start in a bond fund.
Yeah.
Because the typical principal that you're going to give a corporate bond or a treasury bond would be 150. Now it has been reduced about 50,000. But maybe you don't have that 50,000 and you need to start.
Yeah.
Go into a bond fund. As low as 1,000 shillings, you can start. No problem. And every time you want to top up, you can top up 100 bob. For example, the Dr. Coban bond fund is structured that way. Minimum 1,000. Top up whenever you want to top up. No problem.
Yeah.
What you are assured of is that June 30th, utapatiwa ka interest. December 31st, you will get interest. So start there. Then build your capital now for bigger things. And then, like we said in the last, of course, it's not exactly like putting eggs in one basket, but it's always good to understand what is going on. Just like shares, we said, go into an equity fund, but weka hata kidogo direct.
Yeah.
Same thing. Go into a bond fund, let it be sizable. When your income levels increase or whatever it is, then now you say, okay, I can actually put this 50 bond in a treasury bond. Let me see actually how this thing works. Yeah. So that's the route. Go into a bond fund, then maybe you can go direct. With property, unfortunately, we don't have many income real estate investment trusts. I think we only have two if I'm not wrong.
Yeah.
So in terms of property, we are suffering from the same story even when it comes to growth. We don't have collective investment schemes that do a lot of property, but they are there. Yeah. So you have the likes, I think, Aecon have an income REIT. What used to be Stanley, ICA have an income REIT. We also have CPF with an income REIT, though I'm not too sure you can trade as yet. But our market is growing. That's the good thing. Yeah. So as people get educated about how these REITs work, and remember what we said last time, bring the costs down as much as possible so that the investor gets a very good and decent return. We will have more investors as small-time investors, not being directly invested, but through collective investment schemes.
Yeah. Mr. Gitau, what do you want our viewers to take away from this conversation?
One of the key things is, again, diversification. But again, you don't just diversify for the sake of diversification. We've gone through the three investment objectives. We had capital preservation, growth, and income. Typically, that should be the journey in that order, where you start, build your foundation, have your emergency funds, have your insurance in place, because you need to protect the income generating asset, which is yourself. So have your capital preservation in place. Then move on to growth. Grow, double, triple your money over time. Then as you get older, past 50, then you can now start thinking of income. Do not tie a lot of money in rental property at 12%, 11%, when you could have been generating 30, 40% in growth. There will be a time when now the income property will have its own use, and typically that will be later on in life when you want a consistent flow of income. The problem is if you tie too much money in income generating assets, for example, you go and decide you want to do one flat, you forego the doubling of your money such that when the time is right for you to have an income objective, you have now forgone 3 or 4 flats. But, ladies and gentlemen, we are talking about multi-story dwelling units. We're talking about flats. We're talking about, people are thinking, Yoni Awadosi, no. It is possible for you to come together and undertake these projects. Go together into an investment group. The only thing that you need to do is make sure that that investment group has some form of investment policy statement which dictates the objectives of that group and how the money in that group will be used so as to avoid any squabbles. So if the objective is capital growth, then you know exactly what you're doing. Nobody will come up with stories of rental incomes. If the objective is income, then you know you're either investing in bonds or investing in rentals. But always build your foundation first. And money market funds are the best place to start before now you can embark on adding any risk to your investment portfolio. With time, at least the main thing is start. With time, you will fall in love with your investment portfolio for sure.
And everybody loves a nice love story, isn't you? All right. We hope that you will embark onto that financial love story. And Mr. Gitau, we are with you next Thursday again, yes, to complete this conversation about growing your income. And Mr. David Gitau, he is the CEO of Lofty Coburn Investments Limited. And boy, it is going to be an amazing 1 month so far. And if I do not come out of this experience an investor, then there would be a problem with me myself, because I've seen some of our colleagues have already started taking the initiative and reaching out. So you viewer, you should also be able to take that initiative. All right. Thank you very much for making time again, and hoping to see you again next Thursday.
Thank you very much.
All right. Thank you very much for watching. Let us see you tomorrow as we usher in the weekend. My name is Alan Hubbard, sign language interpreter.